Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 11th edition of Market Outlook. So we certainly had a case of post-election blues. Had one of the worst weeks we've had in quite a while, and quite a nasty little sell-off. Anyway, please be sure to take our investor sentiment survey, and we'll be happy to send you the results. And also, sign up for Market Outlooks to get this on a weekly basis. You can go to the website, marketgauge.com, and there'll be a section down below to sign up, and you can get this regularly. So, let's get into the markets. There's a lot of interesting cross currents, primarily the fiscal cliff, potential another yet U.S. debt downgrade if we don't solve those problems, and of course the whole issue in Europe with the sovereign debt and the fiscal crisis over there as well. So let's take a look and see where we are in the markets. First, let's start off with the Qs. You can see on a weekly basis I put in a really interesting channel. This really goes back to the lows that were put in basically in 2008, 2009, and you can see we have a pretty solid channel that we followed all the way up. Couple things to note. Number one, the 200-week moving average still pointing up. We're approaching the 65-week moving average, which actually works pretty good overall as a gauge of the trend. You can see it stopped it right here, a couple times right in here. We penetrated, but basically it's been holding this level. Now, that number comes in around 62, and the trend line here that we put in from the lows really needs to hold. So our guess is while Congress and the president fiddle on Capitol Hill, there still could be potentially more pressure. If that doesn't abate, you could still see that test first at 65 week and also down around that 61 level to 61.50. So you still have a nice potential for more damage. Now, again, I want to point out that we are on a weekly basis about the most oversold we've been in over a year. Now, we reached approximately those levels earlier this year, but we are beneath it now. So you can see on a weekly basis we're pretty beat up. Let's take a look at the daily charts. Some interesting patterns there as well. First of all, what we have is an inside day. So inside days mean compression. After this pretty nasty sell-off, a couple things to note. The 200-day is flattening out. We've now traded 3 consecutive days beneath it, so that is a confirmed phase change to distribution. In addition, this 50-day moving average is moving down on a rapid pulse here. So that is not particularly good. So NASDAQ, leading NASDAQ stocks, clearly under pressure. We're really going to need to have to get above this trend line right here, which is around the 66 level, 66.50, which coincides with sort of a swing area in here. You can see we sort of held it here. It created a nice little level of support, ran up. We then traded beneath this level. Once we broached it, we tried to get through it. We couldn't. So this is a pretty important level, plus the massive sell-off that we had, and the big volume day coincides with this 200-day moving average. So first sign of strength would be getting above the 65.30, but you're going to run into a lot more resistance around 66.50 level. So overall, the picture in NASDAQ not looking too healthy. The best thing that we have going for it is the fact that the weekly charts are extremely oversold. So you got the support levels. The guess here is things continue to deteriorate on Capitol Hill with more bickering. You could get a test of these lower levels around the 61 level, 6150 that I had mentioned on the weekly charts, maybe a little bit higher. But again, on an intraday basis, you can certainly penetrate. And you can see this is really a line in the sand here. This 60 level is really quite important. I just want to go back again to the longer term weekly charts, because this channel here and this trend line is really quite important to hold. It coincides, you can see, with this swing point, and that is really important. I'm going to get back a horizontal line here so you can see what I'm talking about. You can see that this level here right around 60 is really crucial. That contained the market for almost all of 2011. When we broke above it in 2012, it basically has contained the market. So on this test, we really want to see this market hold the trend line, that 65 week, and the last line of resistance is 60 level. If it penetrates 60, we're in deep trouble. But meanwhile, we're not there. This channel is still intact and positive. Okay, let's take a look at the spiders, because that picture is quite a bit better. One thing you can see with the spiders, let's go to the daily chart. We did close right under the 200-day moving average for 2 days in a row. That really does constitute a deterioration in phase. But you can see the slope is still up there. If we can get back above that 200-day, things are pretty much, would be back intact. Now, we do have to contend with this declining or flattening 50, but that could easily turn around. So our best hope and our strongest index right now, the spiders. Let's take a look at some of the market internals. The VIX, interestingly enough, even with the big sell-off, really didn't get that much of a reaction beyond of what we already had going back a couple of weeks now. So that is interesting, that sentiment has not really entered a major panic. However, we are trading above the 200-day moving average, which puts us into a sell mode for the S&P 500 for a longer term view on it. So that is important to take note. We're sitting right above that 200-day moving average. We've done it now for a couple of days. That is not a positive sign. So definitely some concern moving back into the market. But on a shorter term basis, we're sort of back into the meat of the Bollinger Band. So it's not total fear. On the other hand, definitely things have deteriorated a little bit. Now, let's take a look at the composite reading of advanced decline and our up-down volume and the McClellan oscillator. You can see, again, here with the McClellan, we're trading at the lower part of the band, but not, believe it or not, not low enough to have generated a potential buy signal. You can say the same thing has pretty much occurred on a shorter term basis. The advanced declines sort of at the lower end of the range. We sort of bounced up on advanced declines if they're getting a little bit oversold, but without the volume confirmation, not as powerful. So I would say internals, sectors to watch mixed, if the market does recover. The volatility definitely pointing to a sell signal. Act together. One of the things we want to take a look at is IBB. At a couple of sectors. Why do we like IBB? Take a look at the weekly chart here. You can see trends are very, very much intact. That 65 week, very strongly up, stacked above the 200 week, and we are starting, we're looking a bit oversold on the weekly charts. But more importantly, the daily charts, you can see this is the first time since the beginning of the year that we've actually attacked the 200-day moving average. So we're sitting right here. Let's take a look and see. I believe, yes, we closed back over it. So some pretty decent price action here on Friday, closing above the 200-day moving average. So there's a potential setup looking for things that are beat up, and overall still a positive trend. So this is probably one of the better looking sectors, and probably also one of the better looking ones that's the most oversold. Let's take a look at XRT. This is also quite interesting. XRT on a daily basis also never got under the 200-day moving average, not quite as oversold, acting a bit stronger. Also, the 50-day flattening out, but still overall okay. I would be watching the retail sector. Again, the consumer confidence numbers looking a bit better, so this thing dropped in concert with the overall market. But that is one sector to definitely keep an eye out. Also, with the overall look at the economy, the consumers definitely are feeling a little bit better at this point. So let's keep an eye on that. The other thing is IYT, transportation. Let's take a look at transportation. You can see the transportation on a weekly basis. It's got a very interesting pattern. We're sitting right at the 65-week moving average. It is sloping down, but we're basically now started to flatten out a little bit. So one of the things, of course, in Dow theory is if the market starts to move, you really want to see a confirmation in the transportation index. And what's interesting, if we look at this, you can see that we got a really nice trend line here on a weekly basis. So if we can take out the this pivot point here right around 93.50, maybe even starting a little starter position around the 93 level, we could see a nice move in the markets overall. So again, transportation pulling out from this very, very well-defined trend line would be an early warning that things are improving. So let's keep an eye on the transportation sector. Also, if you really want to follow strength, we want to take a look at the XHBs. That is home builders. And as you can see, much to everyone's surprise, home builders have been doing really well. Now, this is not purely home builders, but things related to home improvement, things like that. And you can see we're trading really pretty much at the highs, and the 65-week still really strong. The 200-week definitely pulling up. So that trend, the weekly trend, still well intact. Now, interestingly enough, it's one of the few sectors that tested the rising 50-day on a daily basis. So here is where your strength is, right? If this starts to break down, not a good sign. On the other hand, this is going to be one of the leading sectors to watch for a recovery and a bounce here. This would be the go-to to buy strength, buy the strongest sector on a firming up of the overall market, and this would also be a lead indicator. So that wraps up this week's session. Hope this helps, and look forward to seeing you next week. Thanks, and bye for now.